My name is Michael Gulliford. I manage a fund called Soren IP Capital Management. The IP stands for intellectual property. And I guess what's sort of differentiated about us compared to what I've heard in the last 2 days is I've heard a lot about tangible assets. I've heard a lot about real assets. I don't believe there's been much talk at all about the intangible. That's sort of the realm in which we operate. We generally invest in companies, universities, and law firms where intellectual property is sort of the underlying value component of the deal. We tend to be very focused on patents and trade secrets within that group of IP. Strategy generally breaks down into about a half private credit. That generally is credit situations with companies that have very differentiated intellectual property, where I think unlike a lot of generalist investors who just lean up IP as part of an all asset lead, we feel very comfortable, having been doing this for a very long time, that we're able to understand the value of IP, particularly patents, in a way that most can't, and to lend against those assets. The other half of the business really breaks down into legal finance, particularly on the patent side. There's an interesting dynamic in the IP world that I think is counterintuitive and not obvious. And that is whether you are Columbia University or Qualcomm or any other giant IP owning company, if you seek to license your IP, you're going to have to litigate. That started in around 2015, 2016, due to some changes in the laws that Congress passed, and we can get into sort of where that is now. But what's interesting about that is it creates a really interesting opportunity that we've been focused on for the last 6 or 7 years, and that is in the world of litigation and patent litigation, there's basically two varieties on two sides of the spectrum. One is a very binary, risky, what I would say ill-advised type opportunity that I think finds its way in the market more often than not. And that might be a company acquired some patents or has 1 or 2 patents and is suing some other big company. And we hear about really large damages awards that are possible. But I think for those of us in the space, we know those can go wrong in a lot of different ways and often do. The other side of the equation are large companies. We're dealing quite a bit right now with multinational Asian consumer electronics companies, for instance, that have thousands of patents, and they're trying to license their patents, but litigation is required to force a real negotiation with the counterparty. And so what usually happens, and
we'll dive into this more in depth as we go into our conversation. Right now, we're just doing introductions, so I think you've covered that.
Yeah, I'll finish it up. I'll be quick.
Okay.
And so that's what leads, I think, some interesting angles to do private credit on the legal finance side as well.
Beautiful. I'm sorry to cut you there, but I just
no problem.
We'll move this along. So, Michael, Oliver Weinberg, why don't you take a minute and introduce yourself? Tell us a little bit about your background.
Sure. Thanks, Mark. Nice to see you. Thanks for having us, Marty. Yeah, my background started in sell-side research. Then I transitioned to the buy side, was a portfolio manager at Soros, as well as Credit Suisse. Then I transitioned to allocation, ran a large business at Man Group. Then subsequently, I was chief investment officer at Protege Partners, and then I was at a Dutch pension APG. And then most recently, First Republic. That's sort of 30 years in 30 seconds. And I also teach as an adjunct professor at Columbia Business School for the past decade, course on alternatives and institutional investing.
Fantastic. Thank you for that.
Yeah, thank you.
I'm gonna tell a quick joke here. My father was an obstetrician gynecologist, and he had a patient with 10 kids, and she named all her kids Pat. I said, "Why did you name all your kids Pat?" He says, "When it's dinner time, I say, Pat, it's dinner," and they all come. He goes, "Well, suppose you just one of them. And she said, "Well, then I call them by their last name." I know it's a little poor taste there. But I sort of feel like that's my panel today. I got 2 Michaels. So I'm going to refer to one as Michael J and one as Michael W, okay?
Yeah, that's fine. Yeah. Or Michael O, either.
You know, so it's where I'm coming from here. So we did one of these panels recently, and a panelist by the name of Charles Friedberg argued that strategies like private equity, hedge funds, venture capital were no longer alternative. Last week in San Francisco, we sort of picked up on that theme, and we discussed what an alpha alternative strategy is. and came away with some conclusions. Now, none of these were hard line conclusions. There are a lot of soft, and there's always areas of debate and discussion. But specifically, I think we walked away that has to outperform the benchmark. And we're not talking by a basis point or two. We're talking about a significant upgrade on the benchmark. Usually active management strategies as opposed to passive. These strategies usually identify market inefficiencies that are going to be sustainable for a time period, maybe not forever, but certainly a time period, and whose lifespan, therefore is limited. It's not going to be forever. So timing of the market can be important as to when you get in and out of them. So feel free to add on to that definition or subtract from that definition if you want. And Michael G., I'm going to come your way first with the question here, which is, talk to me. This is actually fund 3 for you, right?
Correct. Yeah.
So maybe you could talk about your first 2 funds and how they performed, and why a family office should be looking at this as a potential, alpha strategy.
Yeah.
And Mike, before you get started,
Absolutely.
can you tell us how you define IP? Is that patents only, or is it trade secrets and copyrights?
Yeah, sure. So I think generally when we talk about intellectual property, we think about patents, we think about trade secrets, we talk about trademarks, we talk about copyrights, and even kind of likeness and kindness, which is, people's likeness and kindness. We've seen that more come in vogue as of late. We are focused on the patent and trade secret side of the world. Those technologies seem to go hand in hand. And I think for the others the other funds out there that are doing IP, it's also generally focused on patents and trade secrets as well. In terms of, just to answer your question, Mark. Yeah, in terms of how we got here, in terms of market inefficiencies, it's been an interesting ride for myself personally. I was a partner at a big law firm, Kirkland & Ellis, about 15 years ago. And in the IP group, and left when we had this big patent troll problem. We've probably all heard of patent trolls, and Congress did a lot to try to, quote unquote, kill patent trolls in kind of 2012, 2013. A lot of big companies were getting tired from getting sued all the time. The problem was the reforms were really sort of not great for American innovators that had to rely on their patents to raise money and protect their products. Congress couldn't really figure out how to just sort of go after the patent trolls, so they made patents very hard across the board to enforce. Fast forward to today, where we're very concerned with IP theft as a country, particularly vis-a-vis China and other countries. And there's kind of a moving back of the pendulum, if so to speak, in Congress particularly. I think there's been a lot of realization that we need to strengthen IP laws and make things right again. And it was really in that inefficiency that we got started with the fund in 2016. The reason was just because the laws changed. When it came to protecting your IP, if your IP was stolen, you used to be able to go to a law firm and have them represent you on contingency. Law firms stopped doing that in around 2016 because they thought it was just too risky based on where things went with a change in the patent laws. And that really created the opportunity to be a financial partner to these IP-rich companies. For us, generally, it's universities that we've all heard of, big household name consumer electronics companies, and small to medium-sized enterprises with big IP. And not having a law firm that would do things on contingency, not having lenders that really understood anything about IP is really what created the niche. It's still a pretty high barrier to entry. Litigation finance is probably the closest, I think, area to what we do. And every day you read about a new litigation finance fund generally, but you don't see a lot of new IP funds. And it's because it's pretty esoteric on the legal side and on the regulatory side. Very hard to do this well if you're not tuned in with Congress, I think, at the ground floor level. And if you're not, you don't come at this from the legal and the business side. So that's really what was the impetus for the fund, Mark, to start in 2016. It's pretty interesting to be in this room. We don't have a lot of family office exposure, to be honest. We had a large pension fund who just came on board last week, actually. They call us their exotic beta. I guess that's where we fit in the ecosystem. But it's been, frankly, for us, it's just been doing it the hard way of building a track record for a number of years with the first 50 or 60 million and having that go very well, and then raising another fund and that go well. We generally, on our credit side, the deal's priced in kind of the high teens to mid 20s. On the legal finance side, it's a lot of structured preferred equity. we're generally shooting for kind of 30 to 45% IRR type marks, which is where we've been traditionally. And it's just a question of scaling, I think, the business model and just keeping very sort of downside protected while we do it.
Yeah, and talk a little bit about, if you would, you know, from a family office, they often, again, they're looking for these alpha alternative strategies, right? These
Yep.
strategies where they can have a sustained advantage in the marketplace for a period of time that generates those, you know, the returns that you're talking about, 30 to 45% IRR. So tell me,
Yep.
why is that baked into your model?
It's baked in because IP is inherently uncertain. It's inherently risky. And I think there's a lot of ways to do it wrong and not a lot of ways to do it right. And there's not a lot of funds that do it at all, frankly. So it creates pricing power, right? When you're a company with really valuable IP and you're looking for a bridge loan, or you're looking to do licensing or file litigation, and you're looking for a financial backer, the universe of investors that actually intimately, I think, understand the asset class and the risk is very small. It's just very, very small. The universe that understand the risk, I think, from a credit perspective and know where these things can go wrong. Traditionally, it's binary outcomes, it's long and unpredictable duration. I think it's an even smaller list that understand that. So when you put it together with the companies, there's not a lot of capital out there that deals in IP, which creates pricing power. And that's just the market that we've seen.
So Michael W.
On your funds?
Traditionally, we've been in the realized, the sort of mid 40s is where we've been today. Yeah.
40.
So
Mid-
Michael
45.
W., I was going to come to you and ask you your reaction to that presentation. And, you know, as somebody who sits in a family office evaluating opportunities, both on a fund level and directs, you know, how did that sound to you? And what is your reaction to what he presented there?
Yeah, I mean, it certainly, you know, it's a potentially interesting opportunity set. I think, you know, I would just hit on one thing you mentioned earlier in terms of our alternatives, no longer alternative. That was, I think, part of your initial question or statement.
Yep.
You know, I think for sophisticated institutions, they're pretty mainstream. But for a lot of families that are less sophisticated, I mean, obviously, for example, when I was at Soros and, you know, sophisticated families like that, alternatives have been a bread and butter for decades. In fact, I mean, George was arguably one of the inventors of the hedge fund industry, but macro and right. But today, where I see the opportunity for alternatives is at the sort of high net worth, ultra high net worth family office, where the penetration rates are still much lower than institutionally. I think that's where the growth in alternatives is and are and will be. And that's why you see all these firms like BlackRock and Blackstone and KKR and Brookfield going after the, you know, mass affluent, high net worth, ultra high net worth families rather than the institutional, because that's mature.
Yeah, I think there's no question. You hear a lot about the topic, and I think yesterday threw out a statistic that said in 2019 that about 16% of family offices assets were allocated to alternatives, and that grew to 21% by the end of 2022, and it's still growing today. In fact,
Yeah,
some
and
people think it's been accelerated. Go
Yeah,
on.
and Mark, too, I mean, for contrast, I mean, you know, you have sophisticated endowments, foundations like Yale, you know, where the allocations are far in excess of 50%, and, you know, even 60, 70%. So yeah, that's where the growth will be.
Yep. So from portfolio advisor's perspective, back on his litigation strategy, and then I'm going to move into some other areas after I ask this question. Yeah, one of the things that strikes me is he's got an expertise that maybe is not easily obtainable by a family office or something like that. So when you evaluate funds and you're looking to move in and hire somebody, a manager, or you want to get into litigation finance, or you want to do more in IP, and I think it's fair because as Michael G described this fund, it's half on the IP side and half on the litigation side. Maybe we'll get into a little more discussions about that in a few minutes. But you know, it seems to me that that's something that's pretty hard to find off the street and to get somebody in order for them to do it themselves directly.
Oh yeah, I mean, irrefutably. I mean, that's for sure. You would definitely need someone with the legal, a firm with legal background and that expertise and the knowledge and the sourcing of deals, and presumably Michael has all that.
Do you actually litigate any of these, the IP or no?
No, we do not. We're sort of value add in the background investors. And generally, sometimes it comes all pre-baked. It's a company that's in a lot of litigation and they have a law firm and they're doing licensing, and that's just about getting comfortable then with the team. And other times a company might come to us and say, listen, we have this problem. Someone stole our technology or our IP. What do we do? And then it's a sort of value add, sort of just relationship of just helping them set it all up the right way.
But you do finance it.
What's your typical slice of the recovery?
Our typical slice, it varies on depending on whether it's sort of three types of return profiles. Credit, right, where we just have an accumulating, just an interest rate that's growing, and when money comes, it pays down the note, and that's it. We're out. That's generally those things priced generally in the high teens to mid 20s with warrants, depending on the situation. When you're talking about legal finance, pure legal finance, that's a multiple type situation. So you'd say, here's X dollars, and our multiple is going to go up over time to just preserve the IRR of where we want to be.
So that's based on some sort of interest.
It's based on a sort of a target IRR, generally of in the sort of kind of 30 to 40% range. Yeah, exactly.
What's the third one?
The third one is just a prepaid forward kind of deal where you're buying a future royalty stream essentially from a company that's doing licensing. And those can be just structured all kinds of different ways. It could just be a percentage. It's over the hallmark is generally when it's a percentage, it's a percentage of a large pot, either a law firm. Yeah, just a lot of revenue streams rather than one event.
What have the MOICs on the prior funds been?
We're more lower MOIC, so we're kind of in like the 1.5, 1.5. If you're looking for kind of multiples, generally, our curse has been we've exited too fast, generally in kind of a year and a half in what we've been doing. We've kind of set ourselves up as a differentiated option to those looking at litigation finance. If you're looking at litigation finance, especially in the IP side, you're going to see, and by the way, if one in this room is ever looking at an IP deal, just call me, please, because so many of them are just not right, and they're pitched as these really sexy things, and they're easy ways to lose your money. But litigation finance, very binary, right? Very binary, high multiples. That's kind of the thing. It's very venture-esque. One big hit, a lot of failures. We're set up more in each of the deals, very downside protected, with a pathway to generally a 2x type of return. We've just been cursed in exiting too fast.
So what are the several litigation finance firms, HR Group, raising capital, et cetera? Do you refer cases to litigation finance firms?
We do.
Hey, I've got a great case. I've looked at the basis for it. Then, we're suing Samsung. The court's probably be in Atlanta. No chance they win. Send it out. I know these guys in Southern California who are big in litigation finance. You probably know them also.
Yeah.
And there's no chance we can lose this case. Minimum we settle and we still make some money. Are you looking at it that way or?
Yeah, we do. We send a lot. I personally just think I've been in this world for a long time, the patent world. I think there's a lot of ways to lose a patent case. And as an investment strategy, if it's not set up in sort of, I think a very downside protected way, it's just a bet, really. And so I think there's a lot of betting going on in the patent space, at least in IP. So we would send that.
How much co-investing takes place? In other words, you put X in, somebody else puts X.
Well, a typical stake is like $10 million.
Yeah, our deals have been north of that, generally in the sort of 10 to 25-ish range, which goes right to the co-investment. There's quite a bit of co-investment in the IP space. We've backed into it the other way. I think in New York, at least, there's some big multi-strat hedge funds that know of our track record and how we do things. So they send all of their IP deals to us, and they invest if we do them. So that leads itself to co-investment. So there's quite a bit.
So in some respects, you're almost like a litigation finance fund of funds.
Not by choice, but yeah, yeah, potentially.
Michael W.
But we
I
don't
wanna-
invest in other litigation finance funds. That's
No, but
we
you
wouldn't.
you refer cases and you invest in a case.
We don't invest in cases.
No?
We would send that to a litigation finance fund. But if it were a company in a sort of, we don't do single event type risk. But if it's a company that has thousands of patents and they want to license 20 people, we see that deal flow gets sent to us from other hedge funds. So we just co-invest with them.
So if you refer a case to a litigation finance firm, is it a retrocession or how does it work?
No, they're just friends. It's a small world.
At least a nice time.
Yeah.
So Michael W., I want to talk about some other interesting strategies that you're looking at today. Tell us a little bit about what gets you excited at CMT Portfolio Advisors.
Yeah, look, with the same caveats that you said earlier, private. So I think I thought the real estate panel that preceded this was very good. I think I won't rehash some of what was said, but I thought a lot of it was spot on. I think in light of what's gone on with the banks, Signature, SVB, and others, you know, and then what are likely to be tighter capital constraints on banks. I think there's a material amount of opportunity, and then you have the $1.5 trillion of commercial mortgage real estate, roughly plus or minus, resetting over the next few years. I think there are massive opportunities in stressed, distressed, rescue finance real estate. Similarly, I think there are opportunities in stressed, distressed credit. I think the opportunity in private credit will be immense, again, because of this, the diminished ability of the banks to lend, because of the real estate. You know, right now we only had a duration crisis for various banks or regional banks recently. The next shoe to drop is the commercial mortgage real estate. We haven't had any credit losses. The last panel, for example, talked about 50% occupied buildings. For example, we had someone who's very well known, who's got a considerable portfolio, and he mentioned he owns an office building in Los Angeles. It's 50% occupied. The mortgage is resetting. He's going to hand back the keys, and I mean, this is a drop in the bucket for that person, and there's going to be so much of that. Now, I think one has to be really careful. It will be treacherous. I think some of that was alluded to on the prior panel. Should I keep going, or?
I have a comment from Michael. Okay, Mark, just 1 second. So
Sure.
we actually were just in California last week in San Francisco, and you don't feel it here. It's really catastrophic, the failure of Silicon Valley Bank and First Republic and Signature. They were the engine for so much of what is, the creative or, the new economy from California. So it's going to be interesting to see how they retool, because there's no easy replacement for that. So what we see here is a nice thing. We're having, problems with real estate, et cetera. It's terrible. It's catastrophic in San Francisco right now. I mean, you talk to the VCs, you talk to everybody else. Well, at some point when things revert back to normal, but,
I agree.
I don't think there ever is going to be reversion to very low interest rates. Maybe talk,
Well, to your point, Marty, I think it's a loss for a lot of communities, particularly California and others, in terms of they were big community lenders, and I don't think with greater potential capital requirements. Again, on the prior panel, a lot of the salient points were hit. Banks will focus on existing customers. They won't be able to make new loans. Great, not to be repetitive, but it really will rein in their ability to lend and provide opportunities for private credit. But then I think one has to be really careful, because it will be a treacherous economic environment. Rates are a lot higher, inflation's higher. You have a lot of companies now with good businesses, but upside down capital structures. A colleague I know is a merchant bank, buys and sells businesses from family offices and to them. And he mentioned, he's seeing these crazy situations where you have these great businesses and there are massive opportunities for restructuring because the capital structures are upside down. And anyone with mortgages that anyone with mortgage, give me 1 sec. Anyone with loans that are resetting. SOFR or LIBOR, what was LIBOR now is SOFR, has gone from 0 to 5, and then again in commercial mortgage real estate, LTVs. They're much lower, cap rates are much higher, valuations are lower. There are going to be these massive equity gaps. Yeah, go on.
There's a little foreign trend that I don't think we talked about, but I know for a fact some of investment firms in the Middle East are gearing up for our pivot, our change in values. In other words, there'll be vulture funds, foreign as well as domestic, for these situations.
Yeah, absolutely.
Gearing up big time.
Absolutely. I mean, I'm seeing interesting opportunities in special situations, real estate, where you can have, you get equity-like returns with credit-like risk. You're senior in the capital structure. You have very low loan to values. You have higher cap rates, and they're very attractive.
Does Marty have a comment on that by chance?
I have one more question, Mark. One of the things that we're finding is people So it's not just real estate, it's pervasive. So we're running into people who are fantastic entrepreneurs or over leveraged. So I had a guy call me up, I have $400 million a year in revenue. JP Morgan just cut his line of credit in half. Right? He's 100% owner. He never took out venture capital or anything like that. So I think there's a lot of, you'll see a lot of that. So
Totally. So venture, yeah, vulture, distressed, stressed, opportunistic. Yeah, I think the opportunity set will be immense.
thank you.
But I think you need to have, I think you also want to invest with firms that have workout experience and have been through down cycles, because, I think that's where we're likely to head. I'll pause there. Mark, you had a question.
No, that's fine. I was just going to jump us into other strategies that you like, and particularly something that's come up in this discussion has been gold and other precious metals, and I wanted to get your sense on that.
Yeah.
Is that-
Yeah, I mean, personally, I think gold is probably more sensible than crypto, but not a gold bug, never been. Obviously you get the leverage in the miners. What I think is more interesting is, and I'm seeing some venture and some other opportunities in rare earth materials and lithium. Those, the demand for those in light of the energy transition will be immense, and the world at this time, for some time, is likely to be undersupplied in both of those categories. And that's where I think there's more of an opportunity. But, they're both, ironically, they're both fraught with environmental implications. Processing rare earth materials is uber environmentally unfriendly, which is one of the reasons that, and China is one of the few countries in the world that will do it. Everyone, Europe and the US need them, but it's like the NIMBY, don't process them in our backyard. Not in my backyard.
Well, it's
NIMBY.
funny because we had a speaker yesterday, Daryl Montgomery, who spoke to that. He said, a lot of our green tech and ESG policies hurt us in a lot of ways, and that was
Absolutely.
perfect example of what he was speaking about. So we need to be smart about how we approach these topics. We shouldn't ignore them either, but we need to be smart about how we approach them. So totally agree. Hey, I want to, and I know you have a lot of opinions on this, Bill, on AI. And last week we had somewhat of an interesting debate between whether it was irrational exuberance or whether it was, vital and important to certain industries. And both of you can probably comment on this. I'm sure, in the IP world, this is probably one of the fastest areas getting IP. A lot of people are writing patents for and trademarks for and things of that nature. So if both of you could comment on this market.
Yeah, not to diverge off topic a little bit, but it's actually interesting. So AI, and my brother in patent law can speak to this as well. People, AI is all in the press. We're reading about it every day. From a patentability standpoint, arguably maybe not so patentable. The Supreme Court in 2014 did a lot to make software hard to patent. And at a minimum, maybe it's the kind of thing that is better left to the trade secret realm, where we don't want to tell people our algorithms or how we're doing all of this. What I'll note is what's interesting in our world is, despite all these AI advances, there's still no tool that can tell you what a good patent is. There's no tool that can tell you if you have this patent, this is going to hold up in litigation, or someone's going to license this. It's still a very much sort of manpower intensive effort, and that I don't even see that close to changing yet.
Yeah, it's it's skimming off the internet right now for information, things along those lines. But I think the thought process is as this gets better and better, and it's going to become more intelligent over time. Michael, what do you say? Michael W, what do you say?
So look, I see immense opportunities with AI in investing. Teams of mine have already been using it to code. Colleagues of mine who are quant portfolio managers are using it to code. I mean, I think it will have an immense implication on society in terms of, I think, for example, the demand for coders among many other professions will diminish because it's for a first stab, it's already pretty good, and that's GPT-4, and that's with a year of data held back, and it's only going to get better. I think discretionary investors will be threatened increasingly because, with GPT-4 or something similar, LLMs, large language models, you can do a lot of what discretionary portfolio managers did more efficiently, faster, cheaper, more efficiently. If you're a discretionary analyst or portfolio manager and you're reading the newspapers, looking at sentiment, you can do that with an LLM in a millisecond, and you can do it for all the companies in the world 24/7. And you can't compare that. It's like when I was a PM at Soros and I used to read the newspaper and I used to read 10 Qs and Ks, and like Buffett, likes to sit in his bathtub and read 10 Qs and Ks. Well, the LLMs, they can do that in a millisecond. So, I was chief investment officer of a company called Move 37 some years ago. And the premise was that machine learning and alternative data would revolutionize discretionary investing. And I think now here we are sort of 7 years from when we founded that. And it's coming to fruition.
I think there's no question.
Oh, sorry.
Yeah, I'm going to be speaking briefly about AI and how it's impacting healthcare. I'm a healthcare guy, and I'll strive to be brief before I do. But in my healthcare space, I think AI has landed. It's been here for a minimum of a year and a half. But two, it's revolutionizing healthcare diagnostics. It's revolutionizing cardiac diagnostics, other areas of diagnostics immensely. I think that in less than 5 years from today, and it's my belief from talking to clients and looking at deals and working on strategies, but I also look at my daily reading, and everyone is saying that, at least in my space, because that's what I'm qualified to talk about, it's going to massively revolutionize in less than 5 years the majority of healthcare, particularly the diagnostic analytics side. In the old days,
Yeah, we're not gonna get into that, and we actually have a disagreement on diagnostics, so we'll talk about it in an healthcare panel.
Yeah, so we can take the discussion later.
Just on that theme though, one of the things we were talking about in the government last week with AI, anybody that's been in the biotech area, all the clinical studies and stuff, just massive amounts of data. So there's a lot of discussion about the benefits of AI going through that data. That's going to be revolutionary somewhat.
Hopefully you get the uniformity, but getting to Michael's point, I'm reading 10 Qs. Instead of reading a 10 Q, you can say, ChatGPT, read every 10 Q,
Correct.
give me a report that looks like this.
Correct. You can
And that's beautiful.
You can systematize what discretionary investors did. So I think it's another nail in the coffin for discretionary investors where the quants will have a greater advantage.
So I just want to bring up another point. It's actually a great book. It's written by Peter Thiel. It's called 0 to 1.
Yeah, read it.
And of course, 0 to 1 it applies to all towards entrepreneurialism, but I think it also applies towards the hedge fund space and the investing space, which is that if you were the first sort of hedge fund, you probably have some runway. If you're the second sort of hedge fund with a minor improvement, you make some money, but it's hard to displace number one, right? So I think the same thing happens in the hedge fund space in that a lot of strategies that were out there in the past have gone away because of disintermediation, technology, whatever. But I think AI creates some runway.
Yeah, and again, that was the premise of this firm, Move 37, that we founded 7 years ago, which was it would be massively disruptive because you have this confluence of machine learning working, data science, exponential growth of data, and low-cost processing and storage. This confluence of these four factors means that quants can do what it faster, cheaper, more efficiently. And yeah, a lot of hedge fund strategies will be obsoleted as they have been historically. Yeah.
News bulletin on what you mentioned before, rare earth will announce Montana will be a processing facility in the United States, and will announce it'll be environmentally benign, developed by national level.
Great. Yeah, that's what we need. We need more of that. Robert, yeah.
Yep, Mike, and for both of you all, just drilling down a little further on AI investing. If you were to manage your parents' money on this, I mean, you've got the opportunity to play in FANGs, Google, Microsoft, and then you've got opportunities to play, direct private, growth companies, and then in between you got fund of funds, what have you. I mean, just speak a little bit of if you were being a conservative approach, but you want to sample this, but you also want to mitigate against complete loss. What's your mindset, guys?
Well, I would say if you want to mitigate against downside, tail risk, and complete loss, then you're probably looking at funds that are employing AI, because the
hedge funds or fund of funds or VC.
Systematic quantitative managers that are employing machine learning and alternative data, I think is one way to mitigate the downside risk.
Maybe liquid strategy. I don't think AI has been used in the real estate space. It's worked very well.
Not yet.
right? I mean, because.
We use it just to be more productive.
I mean, but wasn't Zillow buying and selling based on AI and then they pulled out because they have to loss?
Didn't work very well because,
And that was in the
that whole
application
estimate
understanding of it.
is really wrong.
But again, that's something that I think people underappreciate. Like I've seen this a lot over the last 7 years, where a lot of brilliant coders and Silicon Valley type and California people think because they can program an algorithm to recognize a cat that they can therefore beat the markets, or but there are all sorts of concepts like non-stationarity. Cats are stationary. A cat in Victorian England looked the same as a cat today. Markets in Victorian England didn't look the same as they do today. So markets are non-stationary, and there are all these phenomena that we don't have time to discuss, which are why it's so much more difficult to use AI to beat the markets. And Zillow had that algorithm that forecast housing prices, and then they said, well, again, let's take it one step further and invest in the actual houses. And yeah, sure enough, it was a disaster. So the lesson I'd say is it's always human plus machine. It's not just the machine. You need the human overlay. And the synergy of the two, like, I know we're not having a medical discussion, but like, to me, a machine trained on x-rays with a physician will be far more powerful than any physician.
And just to get to the picks and
Let's
shovels.
touch on that.
So we are
So-
gonna discuss it, but we're not gonna.
Yeah, fine. Sorry.
So, just get to the picks and shovels aspects of AI. I'm gonna tell you, I just talked to somebody, he said that the 5 most scalable AI trading systems have all been sold to hedge funds in the last 3 or 4 years at huge cost, at huge amounts, right? So hedge funds are really buying into it, trying to find any angle they can. So it seems like it's definitely.
Oh, they have to. It's the future. I mean, again, it's massively scalable. Whereas, being a discretionary investor, if I'm a discretionary PM at Soros, I'm looking at 50, 100 stocks, maybe 50, 100 data points per company. I can only have 24 hours in a day. With AI, you can code the computer to look at every 10Q, every 10K in the world, every company simultaneously, 24/7, sentiment analysis, and on it goes.
And it'll be on your breakfast table.
Exactly. And the
And
computer doesn't call them
and
sick
we're at
or work
AI
from home.
0.5. We're at AI 0.5. We're not at AI even 0.1 yet. So
Correct. And I agree.
it's
And
got
there's a bit
so
of a-
much more way to
That's
go.
right. And there's a bit of overhype now with LLMs and GPT-4. You see this in AI over the past 70 years since it was invented post World War II. Sorry.
Have you been any of the Bloomberg AI that's come out, or?
What's that? Say it again.
Bloomberg is putting out a GPT.
Oh, I haven't looked at that yet.
So I do want to move on to other areas, and that got to
We
be
got
a
about
very
3 more
heated and a
minutes.
great discussion. So how much time, Marty?
About 3 more minutes.
3 more minutes. Perfect. Well, let's jump to, there's 2 things I really want to cover here. You touched on crypto a little bit earlier, Michael W. You said you're not a big fan, if I understood what you said. You liked gold better than you did. And certainly last week, the SEC, came out with lawsuits against Coinbase and Binance. Talk to me a little bit about the opportunity sets there, if you see any, and certainly could toss in blockchain and Web 3.0 if you think there's some opportunities with those.
Yeah, I know we're limited in time, but at a high level, yeah, there are some blockchain opportunities that will be interesting. I think that's not going away. I just don't believe in them as a currency or a store of value. I think that the stable coins are the next shoe to drop in that industry. It's just unfathomable to me why we don't see an audit if the assets are really there. It's that simple.
One other quick point on that, and no one's really talking about this, but it struck me with NFTs. Since we live in the world of intangibles, you have an entire generation, like NFTs, the kind of thing the adults in the room laugh at, right? And everyone else is like, what do you mean? I just spent all my money on this digital piece of art or having this first photograph of LeBron James dunking. And so my only point is there's an entire generation that values the intangible in an entirely different way, right? It matters to them, and it's incredibly valuable. And I think the NFT valuations maybe go up and down. We'll see where that turns. But in terms of, I think, the value of intangibles going forward, it's something to keep an eye out for in terms of the next generation.
There's a structural problem in the crypto space, which is the secondary markets don't really exist for most. And you always make more money from the original sale than from reselling, right? And then there's no audit done because there's so many pump and dump schemes in crypto that are offshore, right? So I mean, I know one guy who's built an engineer for marketing, and all he does is it goes out to Twitter and every other social media and pushes crypto. And so you can be an American and hire people in Philippines for $2 an hour just to push the buttons and run those pump and dump schemes nonstop. It will hit some people in the world who will buy into it, right? Nobody knows the scale of it. I personally think, because I've been in the crypto space since 2013, it's massive. It's massive, and people don't really understand how it's done, et cetera.
I
But
think that's awful, and I think it should be regulated, and I think whether it's the SEC or CFTC, someone should be regulating it, because it's no different than Wall Street in the early 20th century when the robber barons were manipulating the market, or, you know, what's illegal in almost every other developed market, security market, is often not illegal in crypto.
yes.
And that's, yeah, it's unfortunate, I think, because.
I want to interject a thought, then I want to move on to the last one. So I want to get it in. I know Marty just took up 2 of our 3 minutes. So
I'll give you 2 more minutes.
thank you, sir. I'll just point out that El Salvador is now running on Bitcoin. Mexico is moving in that direction, and they're viewing it as the alternative to the US dollar. So it's all part of this US de-dollarization program that's going on worldwide. But that was something Daryl spoke about and the room spoke about a lot yesterday. I want to focus quickly on green tech and then domestic versus emerging markets. Just quick thoughts on those as potential investment areas during this time.
You know, can I just say, it's funny you mentioned El Salvador. I should have, yesterday I have a podcast series called Improving Alpha, and I interviewed Jose Eduardo Simon, who's has a family, effectively one of the largest families in El Salvador. They have a business with retail manufacturing in 46 countries, and I should have asked him about his view on that. But my understanding in El Salvador is that it's not really come to fruition and working the way they had hoped. But sorry.
That's all right.
No,
I want you to move on to green tech and then domestic versus emerging markets. That's really want to focus the last 2 minutes.
Sorry. Okay. So domestic versus emerging. You know, yesterday I was with Gavkal. I don't know if anyone knows them. They're a very interesting research provider, been around for years. They were very bullish on the emerging markets, and that precipitated my thinking I need to revisit their hypothesis. I think the opportunities are so immense in what we discussed earlier. And then in terms of clean tech, yeah, look, the green revolution, the energy transition, they're real. Again, you have to be able to separate the wheat from the chaff and pick the winners. And so, you know, there are probably VC opportunities, some existing company opportunities. I'll pause there. I don't know if Michael wants to.
No, I mean, we focus on intellectual property, so not sort of asset classes, but who's holding the fundamental core IP within those segments. And so, I mean, for me, it's all about the US right now. The government is, I think, finally strengthening our patent laws in response to worries about sort of deglobalization and China taking over, and where are we going to be if we have weak IP laws. Ironically, China's IP laws are probably stronger than ours right now. It's not talked about, but it's been a huge effort for China. And there's I think a lot of attention being paid to domestic companies that are going to bring back technologies that have been lost abroad. And I think there's some pretty interesting IP angles there.
Quick, just one final, since we sort of brought this whole topic up now. Michael J., particularly on your fund, talk about regulation risk and how you account for that.
Yeah, I mean, regulation and legal risk is ever present in the IP world. The laws change, probably every 10 years, a little bit here, a little bit there. We account for that by being very attuned, frankly, with Congress. Some of our portfolio companies have testified in front of the House Judiciary Committee. I routinely meet with some senators and congressmen to talk about where things are going. And we're kind of right down the middle, frankly. I think we're less susceptible to it because we're credit investors with, I think, a lot of value behind the deals. But in IP, it is certainly in the spectrum and the pie of risk. I think regulatory and legal is probably half of it.
Fantastic. Well, you guys did a fantastic job. This was a lot of fun. Thank you, Marty. Great time.